right, now let's go on to the next one. In the last video we did this one and this one. Let's go on to interest rates drop in Denmark. So we're going to start out again with the same format. We've got our krone, we've got our dollar market here, and then here for krone we've got dollars per krone, and then here we've got krone per dollar. And again, we'll start out at the standard equilibrium of 15 cents per krone, which is 6.67 krone per dollar. Initial equilibrium. So interest rates drop in Denmark. Now, when you think of interest rates in this context, we want to think about the return on a bond or a savings account, the return on an investment, which means that higher interest rates are attractive to savers. Savers want to buy bonds or open bank accounts in countries with high interest rates because they get a higher yield. And that makes that currency more attractive. Conversely, countries that have lower interest rates become less attractive to savers, and that makes the currency less attractive. So because in this example interest rates drop in Denmark, Denmark's not going to be as attractive place to buy bonds and open bank accounts. So we go back, and again, following the same format, we'll start with our market for krone. How are the Danes going to respond? With the lower interest rates on Danish bonds and Danish bank accounts, the Danes are not going to want to invest in Denmark. But they're going to see the U.S. as a more attractive place to invest because interest rates would be relatively higher. So they're going to actually supply their krone, so supply curve shifts to the right, in order to demand more dollars so that they can purchase higher yielding bonds and bank accounts in the U.S. Now, how would someone in the U.S. respond? Well, in the U.S., we would have higher interest rates and therefore return on bonds and bank accounts than in Denmark. So in that case, the supply of U.S. dollars by Americans is going to shift to the left. There's going to be a decrease. Supply 1. Of course, if supply shifts to the left for dollars, that means that the demand shifts to the left for krones. So Americans are supplying less dollars to the dollar market to demand less krones in the krone market because we don't want to buy as many Danish bonds or Danish bank accounts because of the low interest rates. In contrast, the Danes are supplying more krones to the krone market to demand more dollars in the dollar market to invest in the higher yielding American bonds and American savings accounts. Now let's find our new equilibrium. This is our original. Now we have the intersection of supply 1 and demand 1 in the krone market. Clearly the krone loses value. Let's say it goes down to 10 cents. That's a depreciation, weak currency. And then we can look at the US dollar. We started here, find the intersection of the new curves, demand 1 and supply 1. And now we go up to here. The reciprocal of 0.1 is 10. So the US dollar appreciates. It's a stronger currency. And this makes sense because when interest rates are relatively higher in one country compared to another, that country's currency appreciates because people are going to want to get that currency to get those higher returns on bonds and savings accounts. Okay, let's go on to the next one. So for this one, we've got U.S. imposes higher tax rates and increased regulations on domestic corporations. So what we want to do is the same procedure. We're going to have the krone here and the dollar here. We're going to have the dollars per krone, krone per dollar, And then our initial equilibrium, that's 15 cents per krone. And then here it's 6.67 per dollar. If the U.S. imposes higher tax rates and increased regulations on domestic corporations, that essentially means the U.S. is going to be a less attractive place to invest. Investors don't like high taxes because that cuts into their profits. They have to hand over some of their profits to the government. And they don't like increased regulations because regulations represent costs to businesses, so that raises the costs. Whether you have higher taxes or more regulation, it tends to impair profits and make investing in the U.S. less attractive, especially in stocks. So what we do is we follow the same procedure. Let's start again with the Danish krone, and let's look at how the Danes will respond. Well, if the U.S. is less attractive place to invest, then the Danes aren't going to want to invest in the U.S., which means the supply curve of krones is going to shift to the left. Whatever supply they're already doing, they're going to decrease it. Why would they decrease their supply of krones? Because they're going to decrease their demand for dollars. The demand curve is going to shift to the left. Why would they decrease the demand for dollars? Because they want to invest less in U.S. stocks because of high tax rates and higher regulations on the underlying companies. Now we can think about how the U.S. will respond. In the U.S., we're going to want to invest less here. Americans aren't going to want to invest in the high regulation, high tax environment. They're going to want to invest in Denmark, where regulations and taxes would be less. So the supply of dollars in the dollar market is actually going to shift to the right. But if there's more supply of dollars in the dollar market, that means there's more demand for krones in the krone market. We supply more dollars to demand more krones to invest more in the lower tax, lower regulation environment of Denmark. Now we can compare our equilibriums. Our initial equilibrium in the dollar market was here. Now it's going to intersect with S1 and D1 right there. What happened to the dollar? Well, the dollar loses value. Depreciates. Let's find the new equilibrium for the krone. This is the original equilibrium, but now the krone is going to have a new equilibrium at the intersection of the new supply and new demand curve. So for the krone, we're going to go up here. Let's say this goes to 20 cents per krone. The krone appreciates, strengthens. The dollar depreciates. Of course, if this is 0.2, this must be 5. 5 krones per dollar. So this should make sense. It's very much like interest rates in that if the U.S. had low interest rates, it would be a less attractive place to invest. Well, if the U.S. has higher taxes and increased regulations, it would be a less attractive place to invest. And so the U.S. dollar would lose value. And to the extent Denmark has better interest rates or lower tax rates and less regulation, they're going to be a more attractive place to invest. So the krone is going to increase in value. The dollar is going to lose value. Countries have to be aware of this. If they're going to impose high regulations and taxes, then there's a benefit to that. Obviously, higher taxes generate revenue for the government, and regulations can sometimes be very helpful. They can protect people from an unsafe work environment. They can require that companies provide certain benefits to their employees, and like healthcare and things like that. But from the standpoint of an investor, these take away from profits. They raise the cost of production and make the U.S. less attractive compared to countries that don't have those high taxes and regulations. All right, let's do the next one. So that one was here. Let's do speculators are concerned about the value of the dollar dropping in the future. So for this one, same process. I think you've got it down now, but it's good to practice. Market for dollars here, krones here. Then we have dollars per krone, krones per dollar. Okay. And again, 15 cents, the initial equilibrium, which is 6.67 here. If speculators believe that the value of the dollar is going to drop in the future, how are they going to respond? Well, again, let's start with the Danes. Are the Danes going to want to supply more or less? Well, if they think the dollar is going to drop in the future, they don't want to buy dollars, so they're going to supply less krones. Supply curve for krones is going to shift to the left. Why? Because they want to demand less dollars. How are Americans going to respond? Well, if we think the dollar is going to drop in the future, we want to get rid of dollars, so we're going to supply more. Supply curve for dollars is going to shift to the right. But that means that the demand for krones is going to shift to the right. New equilibrium. Here's the original. Now we find the new krone equilibrium where S1 intersects D1. Say this goes up to 0.20. Krone appreciates, strengthens in value. The original dollar equilibrium is here. Now the new one, D1 S1 intersection, is here. Dollar depreciates. This is 0.2. This is 5. The dollar loses value, weakens. And again, this should make sense. If we think the value of the dollar is going to go down, people aren't going to want dollars. Dollar is going to lose value. But to say the dollar is going to go down is the same as saying we believe the krone is going to go up. So the krone is going to appreciate. This brings into play expectations. Because when people expect the dollar to lose value, to drop in the future, they actually bring that about and strengthen the krone. Okay, so that wraps up the 5 possibilities. Now you have the graphs to go with it. Let's summarize. So notice that these first 2 here are related to the idea of importing. This is GDP grows in Denmark. They want to import more from the U.S. Inflation rates are higher in the U.S. than in Denmark. People want to import more from Denmark than the U.S. So this all has to do with importing. These 2 have to do with investing. Interest rates, or the return on an investment. Regulations, taxes affect the return on an investment. And then this one is obviously speculation. So if you go back to the beginning here, if you recall, we were looking at this in a previous slide, or a previous video. Remember, the reason that there is a foreign exchange market is because of importing, investing, and speculation. And then we said these are the factors that influence. So the first 2 influence the desire to import. The second 2, interest rates in business and investment climate, affect the desire to invest. And then finally, expectations of currency affect speculation. This all ties together. It's also important to keep in mind that there were 2 markets involved in all of these. When both citizens of the United States and citizens of Denmark responded to the change, which was true of number 2, 3, 4, and 5, all the curves shifted. However, in this first instance, when we looked at GDP changing, GDP/income, only the people in Denmark responded. So keep that in mind. If GDP and income are growing in a country, those people will respond. The Danes want to purchase more at home and abroad, so they supply more krones to demand more dollars to shop in America. But Americans don't necessarily change their purchases of Danish goods when GDP grows in Denmark. So this is the one instance where we often see only 2 curves shift. The other ones all curve shift.